I think how we were going to start. First, let me thank Dana. Thank you for that introduction. And Neil Mahoney, welcome to SIEPR. He's the recent took over as head of SIEPR, and you see from today in this program, SIEPR and super is only one letter different, and you can see it. Thank you for inviting me back. I was nervous because Dana said, "Oh yeah, I got dirt on you," and I was like, "Yeah, dirt." And then she's like, "I got it from your friend Lily, who I went to college with and works at." I was like, "Whoa, wait a minute, wait." So I appreciate you didn't include any of that. So why don't I say a couple of, we're gonna have some questions and us have a conversation. We're gonna go to you if anybody has any questions. You know I'm 30 years on the faculty, so if nobody has questions, I'll filibuster all night, like whatever you need. But I thought I would start with just a couple of thoughts of what I've been thinking about regarding productivity. I'm often asked by media, what's one number that we should be talking about and aren't? And you know that if you ask economists a simple question, you seldom get a simple answer. But here there is a simple answer. The answer is productivity growth is the single most important number for our standard of living, and nobody talks about it, or they talk about it very little. And I want to start, we'll see if this thing works. Something strange and wonderful has happened in the last 2 years in the data. Oh yeah, okay, we got it over there.
Yeah, and on the other side.
That's the strange, you're like, yeah, what is it? Well, what it is, this green line is trend productivity growth from going back to the financial crisis up to COVID, okay? Productivity is a noisy series that bobs around, but it tends to, over long periods, go at some rate. And in the last 2 years, productivity growth, that orange line has been steeper than the green line, which is to say productivity growth has actually been significantly faster than what it was for more than a decade before COVID. And it's now, a lot of people thought that's just reversion to the mean. In COVID, it went down. Once it gets back to the projected, what the trend was gonna be from before COVID, it'll stop, but it didn't stop. Okay, so now we're a fair bit above where we were. And that has ignited the research fuel. What happened? Is that real? And is it going to continue? There are 4 working explanations that the economists have argued about. And the thing that I'll emphasize is 3 of the 4 basically suggest that was a one-time thing and that it's going to go away. That there were reasons why productivity, the level might have gone up, but there's no reason that the growth rate would continue. But one of them, there is. Explanation 1 is that it was work from home, okay? And Nick Bloom, he might not be here at dinner, but he was here today. He's Stanford's own identifier of working hybrid improves productivity. I think he objected to a couple of the things Jamie Dimon had to say there, but whether you're in the space that's a big increase in productivity or not, it is the case that that's a one-time thing, okay? So we have an increase of hybrid work, but we're not gonna keep increasing the amount of hybrid work, so that'd be a one-time bump up, and then we're gonna go back to the regular growth rate. The second is what the economists call labor reallocation and increased match quality, which tells you exactly why you should never ask message advice from somebody with a PhD in economics, okay? But all that means is, before COVID, everybody was in a job and they didn't really like their job, and then The Great Resignation allowed us to re-scramble and align with jobs that we're better suited to. Again, that'd be a one-time, if you believe that, that'd be a one-time bump up in our productivity, but then we go back to growth rate of what it was before. Explanation 3 is if you look at startups, just the number of new businesses formed, what they call the business dynamism, we had a pretty steady flow of new business startups. And in COVID, that number, if it was 100,000 a year, it jumps to 140,000 a year. And it stays there. And that the new, younger firms have higher productivity. But again, that's another reason why we would have a jump up one time, but that's not a reason why the growth rate would stay higher forever. Which brings us to the fourth, which is where a lot of you probably already were, which is AI and technology. Okay, now I want to warn you, that's the most common thing for the informed public to say, and it's the one that the economists are the most skeptical about, because they say there's not enough. The adoption hasn't been fast enough. If you just look at the penetration of AI in the economy, there's not enough AI to explain why the entire economy's productivity growth rate rose like that. But the important thing about a technology-based explanation is that it doesn't have to be a one-time thing. Because if you look at what you call them general purpose technologies, electricity, telephones, computers, things like that, they slowly spread their way through the economy. And so even if it's not permanent, it's at least more than a one and done, which is what the other ones would be one and done. Our economists at the Federal Reserve Bank of Chicago, I think I got some other slides. Dang it. Yeah, okay. Oh, man. Okay, I'm an old man now. I can't read that. But you don't need to see. You don't need to see. Take my word for it. Yeah, this is our Federal Reserve Bank of Chicago economists got the change in productivity growth rates from the decade before COVID to the COVID to now period. Okay, so this isn't what the productivity growth was. This is how much did it increase the productivity growth rate. Several of those explanations kind of suggest it should be broad-based and the Great Resignation will affect everybody, all the industries. What this thing shows you is there are a bunch of very big drivers of where the productivity growth increase came from. And there are actually a bunch of industries that are negative, that productivity slowed down. I have a paper about productivity in the construction industry, and actually over an extended period of time, productivity growth in construction was negative. Not just here it shows it got a lot worse, but even the level was actually negative. And if you look at the top 10 here, now you can read them. My observation is that of the top 10 drivers, so these are take those top 10, 7 or 8 of the top 10 are some kind of technology related something that feels like AI. Okay, now this is not the econometrics on this is not going to pass muster of the SIEPR crowd. But just it's internet publishing, it's miscellaneous professional, scientific and technical services, e-commerce. I hesitated putting up management of companies. People were like, yeah, exactly, management of companies. But it's a lot of stuff that's, if not screams, at least speaks loudly, technology. There was some invention. And if there is a new technology, call it AI or call it something else, then it doesn't have to be a one-off. And I would be remiss to come to Stanford and talk about technology diffusion and not mention Paul David and the Stanford School of Innovation Economics. Paul David was an economic historian here, and he coined the phrase general purpose technology engines and looked at the spread of electricity initially and other technologies like that, engines and those things. And what you see when those happen is the productivity growth starts in the electricity producing sector itself. That's where it is. Then, with a lag of some years, it spreads to the heaviest electricity using industries. You see productivity growth there. And then eventually, companies start reorganizing to take advantage of the new technology, and then you start seeing it spread way out of the initial thing. And that happened with computers. It started in the computer manufacturing business, then it spread to industries that were the heaviest computer users, and eventually Walmart incorporates information technology into its inventory management system, and you start seeing big productivity gains in retail and in a bunch of sectors that at first glance don't look like that. Now, I'm not saying that this proves in any way that AI is a general purpose technology, but I am saying if it is coming from a technology, not a reallocation of labor, not a one-time hit from people working hybrid from home, or a one-time increase in the number of firms, as that spreads through the economy from industry to industry, outside of just these, you could still get some more productivity kick from it. And I think that's my last slide. Then what are the monetary policy implications if it were a lasting productivity growth surge? So not permanent, but if it was like the 90s, where we got 5 or 8 really strong productivity growth years. And I guess I want to just highlight a little bit of attention in the short run. For the most part, higher productivity growth is fantastic. Like I said, this is what determines our standard of living. It's great for the economy. It's great for wages. It's great for the central bank. We can grow faster without inflation. We can have faster wage growth without inflation. If you were around for the 1990s episode, it is reminiscent of the Greenspan Fed, where computers and the internet showed up in the productivity statistics, very solid increase in the growth rate, and that allowed the Fed, though there was a lot of public pressure because the growth rate was so high, there were people saying there's going to be inflation, the economy is overheating, but the Fed did not raise rates for years, and lo and behold, there was no inflation, and it came from the productivity. So on one hand, it gives the Fed running room. But on the other hand, there is a danger in the short run from getting out too far ahead of reality. And by that I mean, all the economic actors are forward-looking. If they believe that there is a bounty from productivity growth to come, and that leads to a massive investment in AI-adjacent infrastructure, you will find out that the same grubby capacity constraints in the near term that always lead to overheating if demand is too high will kick in. It will make the fight against inflation harder. If anticipation of this productivity growth drives up equity values so high that wealth expands and the wealth effect, they start consuming more out of the future bounty, you will have overheating of in consumer spending. And so there is a way in which the anticipation of productivity growth can actually force the Fed's hand to be tighter, to be more cognizant of the dangers of overheating in the short run. So I guess my summary is I am intrigued, I'm hopeful that I'm excited. I'm excited about the prospects that original graph showing productivity growth's been, let's call it 2.5 instead of 1.5, lasts, that potentially could last because of AI or technology, and that this could spread through the economy, that a lot of the things that people in this room sitting on this stage are working on could drive a renaissance period that makes my life easier as a central banker, but also makes the growth rate higher. But it's not going to be easy to tell whether it's permanent or temporary. It's just a purely statistical matter. If you said, given the variability of the productivity data, how long would it take you to be able to statistically tell that this wasn't temporary? And the answer is years and years and years of observations. Okay, so to me, that says we need to get out and talk to industry experts and talk to business leaders, because you can see things before the data can prove them. And that was true in the 90s, and that's true today. But we've got to not give up our skepticism. If you feed us too much pie in the sky, that we fly too close to the sun and we get into these overheating and anticipation effects, that would be a big mess. That'll be a big mess. Okay, so that's my starting point. What do you think, Alan?
That's a tough one to follow.
Do you agree?
Well, so look, I think all of Silicon Valley believes that AI has enormous potential to increase society's productivity. I don't know that people have thought about just how diffused it is in the economy yet. I think more of but there's definitely a belief that there's a pot of gold and there's an enormous amount of CapEx going in. We heard Ruth talk about $75 billion for Google, and that's coming from all the top 5 players just in data centers. I was curious, normally you talk about technology-infused productivity as an unalloyed good, right? It's great for society. I mean, one of the topics that comes out a lot and has come up earlier today is, what if the economy and society can't adjust fast enough? I mean, we just had essentially massive opening of the global economy over the last 30 years. And reality is Western societies, as I think current events prove, had a hard time adjusting to that, and that was over 30 years. This change might be happening much faster, and there might be a hesitancy to slow down in any way because of national security considerations. So how does the Fed think about that and whether that kind of blows up the system?
I should have said at the beginning, and now my chief of staff's there, she's going to get mad at me. I should have said at the beginning, the disclaimer, these views are my own and nothing that I say represents any other members of the FOMC or the Federal Reserve System. So that said, I can't answer what does the Fed think. I can only answer what I think. The second part of the question about national security, I don't know. I'm not a national security expert.
I was viewing that more as a constraint.
You identified, to my mind, the key point is how fast is this thing going to be adopted?
Right.
And it's worth remembering that in the case of electricity, in the 19-teens, electricity rolls out. It's totally obvious it's cheaper and the better way to do it rather than wind power and water power, which is driving it. And yet, I think the data show that by 1940, there's still 20% of the manufacturers do not have electricity. And so there is a tail, technology diffusion tail that suggests that the adoption might not be near as fast as the quality. If you talk to the tech people, they're kind of viewing, Vinod Khosla told me he thinks 80% of the tasks of 80% of the jobs will be replaced by AI within 5 years. Okay, Ooh, that seemed pretty fast, you know. And I kind of think.
But no, it's a Super Bowl.
Yeah. So if spread out over time, I still think the history of technology, there have been millions and millions and millions of jobs replaced with technology. And the unemployment rate is not 99%. You know, we've still got an unemployment rate of 4% because people are going into new things all the time. So I kind of think that's there was a now famous economics of AI panel where they brought in all of these top economists and all of these top AI people. And every panel was the tech person saying, you have no idea how great this is. This is going to replace everything. And then the economist saying, but stuff's been replaced before. It'll be fine. No, you don't understand. This is going to, and we just went back and forth like that.
Exactly. Yes. All right, let's zoom out a little bit and maybe give people some context. So you sit on the FOMC. I think most people in the room probably know you set the federal funds rate.
Yeah.
What else does a Reserve
What do
governor
you do all day?
What do you do all day?
Okay. That's a two-part question. Okay. That's a two-part question. And a part of it, when Jamie Dimon was railing about the Fed, I was like, wait a minute, that's the DC Fed he's talking about. That's not us. We're not there 5 days a month. Like, what is he talking about? But, so the Federal Reserve System was created in 1913. And it's a little kludgy. I'm going to describe to you how it's set up. You're going to be like, that's weird. But in 1913, as today, people were fundamentally not comfortable with the idea that Washington, D.C. and New York City would together run the entire financial system with no input from the rest of the country. And so they set up a program in which there's a board of governors in D.C. with a chair, Jay Powell, and governors. They are political appointees and confirmed by the Senate. And then there are 12 reserve banks that are spread around the country that each have a region, that they represent this region. For the Chicago Fed, it's kind of heart of the Midwest. It's most of Illinois, Indiana, Michigan, Wisconsin, and Iowa. They rotate. They are not political appointees. They are not actually government agencies. They have a board of directors that's made up of business leaders and civic leaders and banking leaders, and they're the ones that choose the presidents. And all of us, come every 6 weeks to Washington to vote on the interest rate. And if you're an econ nerd, like a lot of you are, that is just about the coolest thing in the entire world. Like, you go in and it's just as amazing as like you ever wanted it to be. There's a huge table. They sit around the table. The shades come down so nobody can spy on it. Right. And then they go around and it's like, Jay Powell's going to give, here's where I think the economy is. Here's what I think we should do. And then they're going to go around and everybody speak their piece. So monetary policy is a big part of the job for the reserve banks. Yep. But the reserve banks, I would say there's kind of 5 things. The monetary policy is the thumb. That's what separates us from the animals, you know what I mean? But we have 4 operational. So the Chicago Fed has almost 2,000 employees. We are a bank to banks, okay? We provide a bunch of financial services and payments. That includes most of the wire transfers that are done, ACH, direct deposit, a bunch of those. We started FedNow, a new payments rail. We operate the plumbing of the financial system. The banks, we supervise and regulate the banks. There's a lot of people who are on location at banks, going through, making sure they have capital, blah, blah, blah. They have a master account. All the cash in the economy is printed at the Bureau of Engraving and Printing, sent to the feds, where we have a vault with an 80,000-pound door. And they don't like me saying the exact number, but it's many tens of billions of dollars of cash sitting in there. And the banks send each day Brinks trucks down and say, we need money for our ATM, or we want to, give you back currency, and we pull out the counterfeit and we run it through the machines. And then there's also a big component of not mayor of a small town, but going around the district and meeting with business executives and hearing what do they think about the economy. We had our automotive insight symposium in Detroit. We have a branch in Detroit. And I met with the auto executives at the OEMs and a bunch of suppliers, and all they want to talk about is tariffs. This was before they had announced what they were.
We'll get to that.
What are we going to do? So there's a component of that. Mm-hmm. I say, my colleagues in academics say, well, is it fun? Are you having fun? I say, well, it's a team sport, not an individual sport like academics. There's a massive mission-driven, they're believers. The people work at the Fed, they're absolute believers. And I said, and it's about 85% you work at NASA, and it's about 15% you work at the DMV. And that part you gotta get used to.
I'm closing my eyes and imagining that. Okay, so moving to the Fed's decision making, you were an early proponent or prognosticator that we might have a soft landing a couple of years ago.
Indeed.
I think Jamie Dimon said it. I think most people would agree. Well, it's mostly played out.
We had it.
As you
predicted.
Exactly.
We had it. That's what I said.
Okay. But of course, we're now. What are you doing for me tomorrow?
Yeah. Look,
what is your view? Assuming that you agree that we've mostly accomplished that, what is your view of our forward path?
Okay. So, 2023. I'm not going to tell you anything you don't already know, but I just want to tell it to you with the bracketed exclamation points around it. 2023, something happened that has never happened before, and it was incredible. It was amazing, which is there has never, ever been a time when they cut the inflation rate by more than 2 full percentage points in a single year without a massive recession. Ever. Not just the U.S., right. Anywhere. Right. That's, if you plugged in to the training sample of ChatGPT and said, in December of 2022, when the Bloomberg economists surveyed, said there was a 100% chance of recession in 2023, the training sample would have been right. Every previous episode, when inflation comes down, they said, if you want inflation to come down, what will have to happen? You have to jack the rates way up and have a deep recession. Inflation fell almost as much as it has ever fallen in a single year. And not only was there not a recession, the unemployment rate literally never went above 4%, which is a level at which most economists not very long ago thought it's impossible. Like 4% is below the full unemployment rate. Okay, so far so good. But as we then come through 2023, we hit an inflation bump in the first quarter of 24, where growth is still high, the supply chains are healing, we're getting fast productivity growth, all of that's contributing to how we're able to do it. Then the inflation rate goes up, and so people start saying, maybe we're overheating again. I said, they asked me, am I a dove or a hawk? And I said, I don't even like birds that much. I was a dog. I said, I was one of the data dogs. And the first rule of the data dogs is there's a time for walking and a time for sniffing. And the time for sniffing is when you got a bunch of question marks, then stop and sniff and get all the data, what you can get. I feel like we passed through, it was clear the beginning of 24 was just a blip. It was, if you take the long arc, inflation's still coming down. I still think we're on path to get to 2%, which is our explicit target. Now we've got a number of uncertainties. Some from policy, some from geopolitics and wars in the Middle East and Ukraine and what is going to happen to the productivity growth rate and all of this stuff that it feels a little bit like maybe it's time to go back to sniffing. But I'm still basically pretty something. What? I still feel pretty good that growth has been solid, optimistic, that we're still on path to 2%, and we've stabilized the job market at something like full employment. As of last summer, I was a little nervous because while the unemployment rate, the hiring rate, the payroll jobs numbers, the level was good, they had been getting worse for a year. And again, if you look historically, how many times does it get worse for a year and then stop? The answer is almost never. It almost always just keeps getting worse. I think we slayed that dragon, and it's stabilized. So I guess I'm still in the optimist camp.
So,
and so rates could come down. I still think if we can get the dust out of the air of all of these question marks and, are tariffs going to drive up inflation and should we respond to tariff inflation and all of that, if you take the dot plot where they ask all the members of the FOMC, without names, they're just a dot, they ask them, what do you think will be the appropriate interest rate this year, next year, and then they say in the long run. If you look at the vast majority of the committee believes that rates will eventually settle somewhere fairly far below where we are today. So I think as inflation comes down, we can do that.
Okay, so now that I've buttered you up, we'll go back.
Look at the time.
So I think you're about to undertake a new monetary policy framework review. And there's been some people looking back at Fed's actions prior to this recent magical run, suggesting that maybe Fed was a little slow to react.
Before I got there.
As the inflationary pressures built up. So as we look ahead, do you think that the framework needs review? In what ways would you change it? What are the lessons learned from that episode?
Periodically, the Fed does an official framework review. And they said at the last one they would do another one in 5 years. And so this is the year. Yep. We have a whole process, so I don't want to front run the process and express, here's what I think should be in it. I think your observation that we had a framework that was outlined, arguably it kind of said we should run the economy hot to get the unemployment rate down, full employment, maybe it's even lower. It maybe be okay if there was a little more inflation. It was following 10 years where we never got inflation up to 2%. We were kind of 1.5 to 1.8%. So that, as we went through COVID and then inflation explodes, that looked pretty antiquated pretty quickly. I just want to make sure that whatever framework we write down, it be robust to supply shocks, a lot of changes to conditions that whenever we write down frameworks, in a way you're a prisoner of that time. And I want us to be a little more, I want it to be a little more like the Declaration of Independence, we hold these truths to be self-evident rather than very specific reaction function-y. If X happens, then the Fed will do this. I'm not super comfortable making promises like that.
So there's a lot of both excitement and apprehension in Washington right now. Pretty much everything is up in the air, and I don't expect you to comment on current politics.
I'm not in
exactly. But you'd have to do some scenario planning.
Yes.
And one of the things that gets talked about a lot is tariffs and potential trade changes. How How do you think about preparing for that? What would,
Look,
I think I know. I think I already know what you're going to say about tariffs. So.
Yeah, look, I'm an economist. Like, you can go look up what I said about tariffs, but before I was ever at the Fed. It's going to be what every other economist said. Exactly. We're explicitly non-partisan.
Right.
We don't weigh in on fiscal policy. It's whatever Congress and the president want to pass, it is totally their right to do it. And our job is to react and to think through the scenarios. The Federal Reserve Act says by law we must stabilize prices and maximize employment. And that's kind of it. It's simple to understand. It's not always easy to do. If something affects prices, then the law says we have to think about it. And I believe tariffs affect prices. Now, that said, there is a first pass economically that says a one-time tariff with no retaliation is a one-time cost increase, is a transitory inflation shock. So in theory, you should ignore it, okay? And my only qualm in thinking about that policy is we learned in COVID the supply chain is a little more complicated than the Econ 101 version, and it can take longer to play itself out. So we're going to be in the position of trying to figure out if inflation starts kicking up, which is the part we're supposed to ignore and which is the part that's a sign of overheating. And that's what I call the dust in the air problem. And if you can get the dust out of the air, I still am pretty optimistic about the prospects that rates can come down. But this is going to be a high degree of difficulty for the Fed, I think.
Yeah. I heard you quoted recently as saying, it reminds me of growing up in Denmark. There's no such thing as bad weather. That? No, you didn't say that. But what you said was, there's no such thing as bad weather.
There's only bad clothing. Yeah, exactly.
And,
that's a Chicago motto.
Yes.
And that's a Scandinavian motto.
Exactly.
Too. Yeah, exactly.
And so that kind of reminds me of
that's my thing of okay, you tell me the temperature, and I got the jacket, and I'll tell you what to do. So it's important to take all the policy together. It's not just, we shouldn't just look at tariffs. They could be tax cuts, they could be deregulation, that could increase productivity growth. We could have conditions change all the time. That's partly the way I'd say it. The Fed's job, if you ask what keeps you up at night, the Fed's job is not to sleep at night. Our job is to be up all night thinking through every single thing that could go wrong. And lots of stuff goes wrong. It goes wrong all the time. So we're not scared of, we got to think through scenarios about tariffs. Yes, we got to think through scenarios about bank capital. We got to think through commercial real estate scenarios. We got to think through all of those scenarios, and we will. They're really, really good people.
So I'm going to open it up to questions from the floor. I've got a couple more, so get your questions ready. We'll have runners with microphones. But let's pivot a little bit. Okay. So
that's dangerous.
So I want to talk about leadership.
Oh, okay.
So I'm CEO at Austan, and one of the things that's very important for us is for my team to understand where we're heading and what our short and long-term goals are. So what do you think it's important for the Fed employees to know?
This is a really important question. And in many of the ways, look, I was a professor, I ran the CEA, but now I'm the CEO of a 2,000-person organization. And I felt like I learned a lot from the Fed, the Chicago Fed. All the Feds have slightly different cultures, but Chicago Fed has a very strong culture of believers. These are absolutely, the universe is as big as this, and the Fed's part is only like this. Yep. But in this part of the world, the Fed makes a huge difference, and everybody who works at Chicago Fed knows that. And they're like, we are guardians of the galaxy. We are not the bad guys. We are the good guys. And So I think that public sector leadership, in private sector leadership environments, two of your most high-powered tools are anybody who gets on board, we're going to give them a big bonus, and if you're not on the team, we're going to get rid of you. Okay,
Yep.
It doesn't work like that in an environment like the government or like the Fed. And so I think in public sector type leadership, it's very much about motivation, and it's very much about we join together in this. I always say, the holiest thing that you can give besides your love is your labor, and this is. I told them at Chicago Fed, I was like, look, you are doing God's work if God cared about liquidity ratios and supervision, but you're doing it. And so I do think that motivation is a big part of it.
That's very funny. The Fed controls the short-term rates. If you look at the yield curve now,
Right.
inverted, which suggests that the market maybe has a different set of expectation than it sounds like the majority of the Fed governors about inflation. How do you reconcile that?
Paul Volcker was a dear friend, mentor, and really one of my personal heroes. And he used to say to me, you must remember, our job, he's speaking about the Fed, our job is to act. Their job is to react. Let us not confuse the order, okay? And so my first thing is not so what, but one of our board members who runs a large bank said, I told my people, we can fight the Fed as long as we want, but the last time I checked, the Fed is undefeated. And so there is an element to, it doesn't matter as much if the market expectations differ from what the Fed does, because the market's business model is react as faster than anyone else. And if you just look at what does the market think the rate is going to do, it's up, it's down, it moves like this. And if you compare it to actually the rates, they're very smooth. And the kind of the Fed's job is to be steadier, take a more of a through line. That said, the inversion of the yield curve and the notion that the longer rates are kind of the bigger drivers of the real economy, I think that's true. And so what the Fed does is important, but ultimately there are a bunch of market rates that are partly influenced by the Fed, but partly influenced by a whole bunch of other things too. And we don't control those, So if people are upset about their mortgage rates, that's partly from the Fed, but partly that's determined by some other stuff.
Organic, yeah.
Yeah.
Okay, let's open it up to questions. We have several microphones. I see a hand in the back. We'll go to the middle of the back.
Hi, I'd like to give you a hypothetical question.
Uh-oh.
Yeah.
Okay.
Suppose Doge decides to go to Fort Knox to check the gold supply.
Yeah.
They find out that Goldfinger has been there and James Bond has not. So we're supposed to have 5,000 tons of gold there, and instead we're short like 20%.
Yeah.
So in that case, what happens?
Okay.
What happens to the money supply? I mean, in a way, I guess nothing. There's going to be some really pissed off people. They're going to be like, "Where is my gold?" Our money is not tied to gold in any way. So there was a time if we were on the gold standard and you announced that was start a bank run. Okay, because they'd be like, whoa, wait a minute. I'm supposed to be able to get gold, but now you don't have the assets you said. Since that's not the basis of the money, I don't maybe I shouldn't say that, but I don't know, it's just hypothetically, it doesn't seem like that has any effect on the Fed or the interest rate or something like that, any more than if I told you we once rented an apartment, and I had all these boxes that I had brought from my old apartment, and I put them in storage. And then I went back down there after a year, and like there were no boxes. And I called the landlord, I was like, where's the storage? And he said, oh, I renovated the laundry room, we just threw all that out. And I was like, what happened to my boxes? And finally my wife was like, well, you can't even remember what was in those boxes. And that was 2 years ago. So maybe the gold is like that.
Okay, next. Yeah, back there.
We seem to have a lot of debt in our country, and it seems to be gaining ground even faster than productivity. I appreciate your thinking about our nation's debt.
You're pulling us very close to the fiscal policy sphere, which, like I say, Congress and the president and their collective DC wisdom decide what the debt path should be. We just figure out what are the scenarios and how does it affect the longer term rates and how does it affect our decision making. If you go back and look at what I said before I was ever at the Fed about fiscal policy, it's clear that it's not a sustainable fiscal path. I'm less in the camp that high debt leads to a fiscal crisis of the form US interest rate goes way up. And I always said the biggest problem of debt and deficits is that you have to pay back the money. And so ultimately the lifetime tax rate on kids born today is likely to be a lot higher than the lifetime tax rate was for people born in 1950 or 1970 or that kind of thing. And that's thought of generationally, it's kind of weird. But I don't have any opinion on the fiscal path. They got to decide that one.
Okay, we'll go here. Oh, okay. We'll go there. There was a gentleman here, and then there's a gentleman over here. So.
Right here, I got you.
Oh, she's got you right behind you.
And then over there afterwards. Yep.
Austan Goolsbee, thanks so much for being with us here tonight. I've been following this, the kind of drama around Jay Powell and Trump wanting to sort of put his man in the office, and I think, just editorializing, I think Jay Powell's valiantly pushing back against that. But I was curious, I'd heard people say that Paul Volcker eventually kind of got chucked out by Reagan, and I just didn't know if you can comment a little bit, how much authority does the president have to replace the head of the Federal Reserve?
I'm not a lawyer. I mean, I have no legal background, so I don't know that. I know that the Federal Reserve Act and the system we set up that I described is designed to be as removed from Washington politics as it is possible to be. So the governor's terms are 14-year terms. 12 of the people sitting around the table are not political appointees. They're coming from around the country. The chair is on a 4-year term that's 2 years off of the presidential cycle. So they've tried in every way to create as independent an entity as possible. And if you just go ask economists, they're virtually unanimous that it's really important to have monetary independence, meaning the sitting administration cannot tell the central bank what to do with the interest rate. That's the meaning of monetary independence. Because the reason that they're unanimous about it is just go look at countries where that's not true. The inflation rate is higher, unemployment is higher, the growth rate is slower. And so it's not, I think it's clear to see why that's a problem. And I think Fed independence is really important.
Yeah, unfortunately, universal votes from economists don't necessarily always drive. Over here.
I think all of us in this room were very surprised when we learned about the duration mismatch that caused Silicon Valley Bank to blow up. And I'm very curious how long it took you to sit down with the Chicago bank's regulators just to see that that wasn't happening in your territory. And what was the reaction within the Fed? Because I'm just blown away there wasn't more egg on more people's faces in the Fed, and at least from what I read in the financial press, there didn't seem to be a lot of change or a lot of mea culpas of how the bank regulators are going to look at it differently.
I was agreeing with you until that last sentence. I would encourage you, if you're interested in this, go read the Michael Barr report. It's kind of like the after-action review of what went wrong. I actually think it's pretty forthright about, it's not of the form like mistakes were made. It's like, here's what went wrong. Now, in several of the cases, they identified, not just in general, but at Silicon Valley Bank, they had, I forget what the number was, like 15 major findings. And there was not a enforcement of the you must do it right now. And that led to a lot of discussion about speed, force, and agility and updating. What blew me away, what I could not understand when it happened in Silicon Valley Bank, it wasn't in the Chicago district. We didn't have as many high-flying, we didn't have as much of a tech industry focus as that for the Midwest. So we face some different problems, commercial real estate and others. But what I could not understand is if you knew you have this in your hold-to-maturity account and that you are susceptible to problems if the rates go up, why not hedge the interest rate? And so I read through the report and I just kept asking, well, like why not hedge? And the answer was they did hedge, but then they decided that they didn't think the Fed would have the guts to raise the interest rates as much as the SIEPR was projecting. And so they took the hedges off. They made a bet. They made a bet that rates wouldn't go up. And then when rates went up, it blew them up. I don't know that, that was the sense I agreed with what Jamie Dimon said of like, yes, there is blame to go around, but the primary blame is if you take bets that the interest rate will not rise and then the interest rate rises and you lose your money, I don't totally know how realistic it is to stop it.
Okay, we'll do one more in the back there.
Hi, my name is Anat Mati, and this is about this very question. So I read the same report by Michael Barr, and I disagree that, he, pointed to where the problem was, and the problem was with the supervisors right here in the San Francisco Fed. And sure enough, Silicon Valley Bank took all this risk, but the supervisors failed to see that the bank was insolvent for a few months and that, the problems were just about to materialize. So the way the Fed report characterized the problems was that, there was a big liquidity crisis, but the liquidity crisis came because they were insolvent, and that was there to be seen. So the failure was really that of the regulators and not, obviously Silicon Valley Bank removed the hedges and all of that, but that was for the supervisors to pay attention to. So I disagree that the Fed took the blame as it should have.
Okay, fair. If you don't know, Anat has done really interesting work about banks and keeps their feet to the fire. I would say it's good to see you again. I'm not. Why was that funny? It's good. I was brand new at the Fed I had started in January, and this happened in March. And I was like, well, something welcome this is. What is this? What kind of job have I signed myself up for? Maybe the Fed didn't take 100% of the blame that it should have. It sounds like that's kind of your characterization. There's plenty of blame to go around. It does take some. You should read the report if you're interested in that. To the extent that they were insolvent and they should have seen that they were insolvent, I agree with you. I'm not surprised that you know a lot more about the details than I do.
Yeah. Okay, I think we should wrap here. I just want to say, I think on behalf of the whole room, that I hope that your forecast of a soft landing continues to play out. And we're very fortunate to have you helping shepherd the US
Thank you for
economy.
having me.
Thank you.
Thank you for SIEPR, and thank you, Mayor.
Thank you. Thank you very much.